going to be chatting about predictability of outcomes. We're going to be specifically talking about that within the context of a multi-asset fund. Gareth mentioned that we have in the last 24 months built out capacity and capabilities within the unit trust market. And of course, with the growth of multi-asset funds and the overwhelming use of multi-asset funds between advisors and DFMs and professional fund buyers, we have launched multi-asset funds. So we want to chat about predictability of outcomes, but more generically, we want to chat a bit about our investment philosophy. Now, you probably think that's quite a strange thing from a passive business, but we actually have a very staunch and firm investment philosophy, and that is one of evidence-based investing. Now, evidence-based investing is a buzz term somewhat in the global market, but what it really means is that we make investment decisions, we create portfolio solutions based on the best-in-class evidence available at our disposal so that we can create solutions that are robust and that are most likely to meet your client's outcomes. So in terms of predictability, we're looking at solutions with the highest level of predictability to achieve a particular outcome. Now, usually what this evidence is academically founded, so it's independent. In other words, it's free of biases. It's usually peer-reviewed. It's cited in credible journals. It has a sound economic rationale underpinning it, a behavioral rationale. So it's really robust evidence that we rely on. And these are our 4 pillars of evidence which we rely on as an asset management business to make investment decisions that are best positioned to suit your clients' outcomes. Those are the evidences of cost. Cost, as per Morningstar, being the single largest determinant of a fund's future success. What that really means is that people, process, philosophy, which is actually a Morningstar manager review process, becomes less relevant than simply the costs. Cost is the biggest predictor of how a fund will be successful in the future. So costs extremely important. The second of diversification. Diversification, as Harry Markowitz put it, being the only free lunch in investments. Now, that's often oversimplified and overused, but what it really means is for the same level of expected return, we can achieve it at a lower risk. And within the context of multi-asset, within the context of portfolio constructions, diversification is extremely important. Then there's asset classes. Individually, what are the characteristics of these asset classes? When combined in a strategic way, what is the best outcome for those asset classes? So looking at strategic asset allocation, as Brinson et al. Said, 90% of return variance is delivered by strategic asset allocation, meaning stock selection and tactical asset allocation become almost meaningless in the context of a multi-asset portfolio. And then the fourth lever that we pull on is that of factors or smart beta, the opportunity to leverage characteristics of portfolios that best suit our clients' particular needs. Alternatively, to look for characteristics within shares which can produce a better risk-adjusted return in the long term. And this is all based on evidence, as I mentioned earlier. But you're probably thinking, that's great, that's theory, we all know it. The reality is, how does this work in practice? So we wanted to frame it within the context of the retirement crisis. Now, these headlines may seem a little bit overstated or dramatic, but in fact, they are a reality. Globally, there is a retirement crisis. Locally, even more so. In fact, the World Bank, in recent research, showed South Africa to be one of the worst positioned countries globally in terms of how their citizens will be able to sustain themselves through their retirement. And so when looking at the retirement crisis, we needed to understand why has it happened, and then secondly, what our clients look for. So structurally, what we've seen is we've seen a shift in the last 10, 20 years from DB to DC. With that, a shift of risk from employer to employee, essentially to your clients. They sit with all the risk. Simultaneously, the marvels of modern medicine mean that people are living for longer. Fantastic as it is, for you as advisors, it creates a longevity problem. It will not be unreasonable to expect your clients to live for longer than they worked in retirement. So in other words, a retired client could need to rely on his portfolio for over 40, 50 years, given longevity risks that exist. Simultaneously, we know we've got a low rates environment, and we've essentially got people not saving enough. So we've got all of these structural headwinds. So when looking at retirement solutions, we wanted to understand from you guys, and this is where the live polling comes in, what were you looking for when constructing a client's portfolio? Is it income? Well, there we go. Is it inflation protection, capital protection? Is it perhaps offshore exposure, or is it high alpha? So if possible, if you can get your phones out and we can see what people think. There we go, inflation protection, capital protection. In fact, these three have overwhelmingly been, this is now our 9th session with advisors. We've seen over 300 advisors in this Meet the Managers, and overwhelmingly the responses come out in the same way. What's very interesting is that we see almost no need for high alpha to solve for a retirement problem. Yet 90% of value proposition being positioned by our asset management market is that exactly of high alpha. So it's not a solution to this problem that we're faced with, the retirement problem. So there we go, inflation protection, capital protection, and income. So if we rewind to the beginning in terms of the evidence that exists, we wanted to show how can we create a solution for clients that meets their needs in retirement. And so specifically, I'm going to be talking about our low equity post-retirement fund called the CoreShares Stable Income Fund. And the goals of this fund are threefold. As the response that's been overwhelmingly received from advisors in terms of our feedback is the need for income, essentially the transition from being a salaried employee into the retirement world where your portfolio needs to provide a level of income for you, capital protection to ensure that our clients can sleep at night, to ensure that they rest easy, and of course inflation protection to solve for the longevity problem. Also to solve for the requirement that our income in fact needs to grow. We need growth within our income stream and we need growth within our capital base. So all three of these problems we'd like to look at within the context of our philosophy of evidence-based investing. So the first need of income, when looking at our pillars of evidence, we wanted to understand of how important the cost component was. So the question that we'd like to ask is, yes, we all know that costs are important. Morningstar said costs are the single largest determinant of a fund's future success. But isn't this a pre-retirement thing? Isn't this a 30-year number? 1% over 30 years compounded becomes a large number in terms of our capital. What does it mean in the short term? Does it become more marginal? Is it less important to have low costs in the short term when your client's retired, when you're required to draw on his portfolio monthly or quarterly or annually? Is it more important? So most of us agree. We think costs are important in the long term. That's great. But in the short term, it's not really that important. However, when we look at the evidence, we would like to show you how important costs are in the generation of income, the overwhelmingly largest requirements in retirement. So we had a look at the low equity managers in our market. We had a look at them and we ranked them based on their cost. We didn't look at their performance or their objectives or anything. When we ranked them in quartiles based on their costs, from the first being the cheapest fund managers grouped together and the fourth being the most expensive, we saw an overwhelmingly strong relationship, almost perfect negative relationship between costs and the ability to generate income. And if income is one of the key requirements in a post-retirement solution, then surely costs are important. In fact, the correlation is something like negative 98%. But if we consider this and we look further, this is actually not correlation, this is causation. It's causation because client income equals gross portfolio income minus costs. So there's a direct relationship between your ability to generate income and by the costs that are charged. So the great irony of high-cost managers who are trying to deliver a particular income is that they are simultaneously destroying their value proposition by charging a high fee. So costs are extremely important. One of our key evidences, most specifically when trying to generate income. We also know in the long term, and we'll look at some short-term rolling numbers also, in the long term, costs are extremely important. So what do we do within our solution? Within our low equity fund, the CoreShares Stable Fund, we charge a very low management fee. We charge a retail management fee of 35 basis points, and we ensure efficient execution. It's as simple as that. By keeping costs low, we can deliver better income. But the next question, I suppose, from you is, okay, but there are those managers that exist who can surely select equities or property shares that can deliver more yield, that can deliver more income. And so you're at a disadvantage being in a passive fund. So when we looked at that, we wanted to try and understand whether we were at a disadvantage as CoreShares by just being simple passive. So passive is great for simple asset allocation, but when it comes to seeking a particular outcome, like a client's retirement income, it falls short. So to try and get your understanding of whether you think, okay, yes, costs make sense, but there are guys, surely, who can look at our equity universe and pick high-yielding shares. Or surely they can look at the property universe. So we're unsure, we disagree. No one agrees with the statement, which is fantastic. And when we did this, we considered the context of our portfolios. When we did this, we looked at our smart beta portfolios, and we looked at the ability to deliver income through a rules-based endeavor, leveraging the fourth pillar of evidence, that of factors in smart beta. So smart beta, in this context, is our CoreShares Dividend Aristocrats. It's a very simple strategy. It simply looks at equities which have paid and grown their dividends over a period of greater than 7 years. So it looks for quality dividend-growing businesses. What we found when we looked at this, in terms of the retirement goal, equity with growth that delivered income, this fund, which has over 5 years of live track record, has delivered more income than 96% of general equity peers. So the opportunity for an active manager to have exclusivity on aligning a client's objectives with a portfolio no longer exists within the world of smart beta. And so within our strategy, in our equity block, we use our CoreShares Dividend Aristocrat strategy to deliver the income that is required while still getting exposure to the equity building block and the growth building block based on that. So in addition to the income goal, it has also outperformed 86% of peers over this 5-year period. So factors being a key piece of evidence, and by harnessing that in our equity block, we're able to deliver a level of income, or a high level of income and outcome. So I suppose the next question is, within the context of capital protection, whether or not we have an ability to generate a level of capital protection, or because we use strategic asset allocation as presented by the evidence, are we disadvantaging our clients? Because surely there's an opportunity to use tactical. Surely a manager can exploit environments where interest rate regimes, macro regimes, geopolitical regimes, to be able to create more capital protection for our clients. So the question is, my manager exploits opportunities to protect clients' capital by tactically shifting between asset classes. 50% of the time is 38% of our answer. Okay, there we go. So a lot of us think, yes, this can happen. That's what managers are doing in the multi-asset context. So again, we looked at the numbers. We wanted to understand whether this was in fact a reality. And the reality is that tactical asset allocation, on average, delivers a worse outcome in terms of consistency and in terms of downside protection than strategic asset allocation. And how we measured this is, again, we looked at the low equity category, and we said, of the managers who are tactical asset allocators, how have they done on a 3-year rolling period basis? So in the 3-year, in the short term, when we need to protect capital, how have they done relative to CPI plus 3? We found that 34% of the time they managed to achieve this goal. What we then did was we looked individually at each of these managers. There were some 22 with a long enough track record, and we actually looked at their long-term strategic asset allocation. We then in-housed their own building blocks to get an idea of how they would have done had they just used their own strategic asset allocation. So it's not ours, but their own. And we found, had they just used their own strategic asset allocation, had they, at every quarterly investment meeting, ignored the noise and said, let's just stick to our long-term strategic asset allocation because that's best positioned to deliver on our clients' outcomes, they would have actually achieved an outcome almost twice, almost 100% more of the time. So the opportunity to achieve CPI plus 3 over 34% of the time increases to 52% of the time. So that's a staggering outcome. In terms of our solution, what do we believe? Well, we believe in terms of capital protection, in terms of achieving our clients' particular outcomes in the short term, we need to utilize strategic asset allocation. A, because it's evidence that globally exists, but B, because it's the evidence that also exists locally, and we believe it's best positioned to deliver on a client's particular needs. The next question, I suppose, is, okay, so what tools do you have at your disposal then as a passive manager, as a rules-based manager, to deliver on outcomes? So the question is, what is the most important downside protection tool in multi-asset funds? Is it forecastability? Is it tactical asset allocation? Is it diversification? Is it defensive assets? Again, this has been overwhelming in terms of the response that we've got, where diversification trumps all else. What's even more interesting is that no one has selected on tactical asset allocation or forecastability. Yet, when we ask the question about how successful their managers are in terms of tactically asset allocating, a lot of people said, well, 50% of the time our guys are getting it right. But when we ask them, can they forecast, they say no. Surely tactical asset allocation is an ability to forecast into the future, to position your portfolio, to protect capital. Even evaluation is a forecast. So it's interesting that no one believes active managers can forecast, yet we believe they can tactically asset allocate. Just an observation that we've seen, and it's consistent across all of the regions. So yes, we're in line with you. Exactly how you've responded, we believe the same, that diversification and defensive assets combined is the best way to protect clients' capital in the long term. So in order to achieve this, we simply maximize diversification. We maximize it by having maximum geographic diversification, by having global equities, global bonds, global property within our portfolio construct, and maximizing diversification at our local portfolio, SA equity, SA property, inflation-linked bonds, nominal bonds, SA credit, SA cash, so not being exclusionary on any of the asset classes. And within these asset classes, we maximize diversification in terms of reducing single stock risk. So within our low equity fund, we have exposure to over 8,900 shares. The average low equity fund has exposure to less than 100 shares. How do we achieve this? Well, globally, most of the shares are combined there. But even in the local context, we achieve the maximum diversification by using portfolio construction techniques, by using single stock caps, by using equal weighting methodologies, and so forth. So maximizing diversification is on the one hand, maximizing geographic diversification, and then asset class. Now, the question that remains is within our opportunity set, and if you're familiar with a lot of the passive building blocks, you may find they don't have exposure to SA credit. And they don't have exposure to SA credit quite simply because you can't index it because of the illiquidity of that market. So what have we done in that instance? How have we given you access to that market? Because, of course, the credit premium means higher income delivered for clients. In addition, it means more diversification. So in that instance, to create the most optimal solution, to create the most client-friendly solution, we've used active credit. And we've used active credit because if we had excluded it, we would have created a worse solution. It's not necessarily a view on active versus passive. So within this context, diversification within our solution, this is how we look at capital protection. We look at it through strategic asset allocation, and we look at it through diversification and defensive assets by holding them all of the different asset classes. In terms of inflation protection, the next question is, how do we expect this particular outcome of inflationary protection to come out within a client's portfolio? So the question is, since 1904, how often has SA equity outperformed SA inflation over 3-year rolling periods? Now, this is extremely important. If we consider structurally in our multi-asset category, we're seeing money move from low equity into high income funds. So if that is a reflection of how the market feels, then we should be feeling that perhaps equity doesn't deliver on a 3-year inflation beating criteria. But what we see is the overwhelming response is that 75% of 3-year rolling periods, equity beats inflation. And this means, in order to beat inflation, we need to look at the next, all of the asset classes and have sufficient exposure to equity. When looking at bonds, over a 3-year rolling period, how often has bonds beaten inflation? So if we are seeing money moving structurally from low equity into high income funds, into bond funds, surely it should be 75% of the time. But we don't see people believe that this is generated 75% of the time. In fact, 60% of the time is the correct answer. So 60% of the time, over a 3-year rolling period, bonds will beat inflation. Not as high as the equity building block, which is 75% of the time. So with that in mind, we've looked at having sufficient exposure to growth assets. With longevity as a particular risk in a client's portfolio, we need to ensure that we've got sufficient exposure to growth assets, 47.5% of the portfolio, to achieve this inflation-beating returns. Without that, we're simply lowering our probability and lowering our chances of achieving inflation-beating returns of our clients having a sustainable retirement. So if we looked at slightly longer periods, if we believe a client's going to be invested for 40, 30 years while they're retired, we need to understand. And what we saw was that, yes, the relationship holds over the long term. So 90% of the time, equity beats inflation over a 7-year period. 62% of the time, bonds will beat inflation over a 7-year period. But the minute we go to CPI plus 3, the minute we go to inflation plus 3, which is most of our clients' goal, we see the probability of bonds achieving inflation plus 3 drop to an extremely low level, to a level that we don't believe is acceptable within our clients' portfolios. So do we exclude bonds? No, but are we cognizant of the inflation characteristics of the assets, of the evidence that exists? Yes. So sufficient exposure to growth assets, equity and property, is extremely important in the portfolio. And then within the context, originally when I first outlaid the evidence and how important it is in the near term in terms of delivering income, we also wanted to see how important is it in terms of delivering on a CPI plus 3 over a 3-year rolling window. So in the intermediate term, how important is equity in terms of delivering this outcome? So what we looked at, and we did exactly the same thing, how important are the costs? We split them into quartiles. Most expensive funds on the left, cheapest funds on the right. And again, we found an overwhelming relationship between the cost of fund charges and the ability to deliver on CPI plus 3 in the intermediate term, in terms of that 3-year rolling window. We see the odds of you achieving your CPI plus 3 outcome almost double when we go from the lowest quartile or the highest fee quartile to the cheapest quartile. And by the way, the TER of the average fund in this quartile is around 1.46%. So not even particularly cheap. So in this instance, we believe that costs are important in the delivery of income, in the long-term goal in terms of that 1% negative compound over long periods of time, but also in the intermediate terms. So it's undeniable that costs are important in all considerations of portfolio construction. Bringing it all together, we believe that we can harness the evidence that exists in the market through our evidence-based investment philosophy to generate a low equity fund which delivers on the client-specific requirements within retirement. That of income need, so that the ability to deliver a high level of income, sustainable income, through low costs, through the use of smart beta, and through the appropriate asset allocation. The opportunity to protect capital by diversifying, by using defensive assets, and by using strategic asset allocation. In addition, the opportunity to protect from inflation, again by using strategic asset allocation, but importantly by having sufficient exposure to growth assets. So an exposure to growth assets of some 47%, which relative to the category average is high. And then, of course, all of this wrapped within a low-cost environment. So a management fee of 35 basis points and a TER expected to be 52 basis points. So this is the Stable Income Fund in terms of our asset allocation. The LISP access, currently it's available on Glacier, Momentum, and Global Nominees. Of course, we're working to get it onto all the other platforms. In terms of our unit trust business, we have access on all of the platforms in the local market. So to load one on is relatively easy if you can just let us know which platform you'd like to see this represented on. And of course, there's the asset allocation, and all of this is wrapped within a low-cost environment. So thank you for your time this morning. If there are any questions, please fire away. We've got some time to take Q&A. So it's open to the floor, or you could ask questions on the app.
If you want to have a look at the questions there, read them out.
Sure. So the first question says, how often is the fund rebalanced? It's rebalanced semi-annually. So we move back into alignment with strategic asset allocation twice a year, essentially. That's a consideration of the costs of rebalancing. So to control for the TIC, we have less frequent rebalances than say, quarterly or monthly or weekly. The next question we have is, What is the yield on Dividend Aristocrats? So Dividend Aristocrats yield is around 4.5% gross. So relative to the market, there's about a 50 basis points, 60 basis points yield pickup. The idea with Dividend Aristocrats is that it's not a high yield fund, but it's a quality yield fund. So we look for that yield growth component, so the sustainability and the ability to grow yields over long periods of time. So that's the yield. The yield on this portfolio is around 6.3% gross. And that's obviously delivered through the different asset classes, through the credit bucket, through the property bucket, the bonds, etc. What is the property benchmark is another question. So thanks for all these questions coming through. Our property benchmark is also actually a smart beta property benchmark. It's one that so Dividend Aristocrats is in conjunction with S&P Dow Jones. In addition, our property portfolio is in conjunction with S&P Dow Jones, where we use a yield tilting. So we look to seek higher levels of income from our property bucket, but we do this within a risk-constrained way. So we look to maximize diversification at the same time. So through our equity smart beta and our property smart beta, we look to boost yields, to boost growth, and to diversify. So from a portfolio construction perspective, to maximize diversification. Is there a high equity version of this? Yes, there is. It's called the CoreShares Wealth Accumulation Fund. It, of course, has a very different asset allocation. And the main difference between the two funds is where we use Dividend Aristocrats as the core equity building block within our low equity fund. Within our high equity fund, we use the evidence of factors, so characteristics of portfolios to deliver long-term alpha. So we use a multi-factor portfolio construct in the equity block there. But otherwise, we use all the other same equity building blocks. What you'll notice here is that our local equity is actually split half in smart beta, so that Dividend Aristocrats methodology is 50% of our local equity, and the other half is in a top 50 construct. And the reason that we do that is to maximize diversification on the one hand. It's to avoid any of the undue risks from having a dividend philosophy. If you scrutinize dividend philosophies, what you'll find is they overweight financials, they overweight consumer staples, consumer discretionaries. So by blending it with beta, we diversify away those risks which we believe are undue in a portfolio. That's all the questions on our app, but you're more than welcome to ask them verbally and we can interact. But thank you for your time.